Order filled. Order filled. Order filled. Order filled.
Hello friends, welcome back to the channel. I'm really excited for today's video because we're diving into something that every trader, beginner or pro, must understand: the best strategies for options trading. Options can be confusing at first, but once you master these strategies, you'll see how powerful and profitable they can be. In this video, we'll explore some of the most effective proven option strategies that traders actually use, not just in theory, but in real trading environments. And here's the best part: these strategies aren't random tips from the internet. They're taken directly from some of the most trusted and powerful trading books ever written. Books that are read by serious traders around the world, packed with timeless wisdom and practical techniques. So if you're someone who wants to learn how to generate income, manage risk, or buy stocks at better prices, this video is for you. And hey, if you find value in today's content, don't forget to like, share, and subscribe to the channel. Let's grow and learn together, one smart trade at a time. Now let's get started. Options trading isn't just about picking strategies. It's also about discipline, preparation, and smart decisions. Because even the best setup can fail if you ignore the basics. So before you hit that buy button, let's cover the must-know general tips that separate amateurs from consistently profitable traders. 1. Risk management. Protect first, profit later. This is your survival kit. Golden rule: never risk more than 1 to 5% of your total portfolio on any single options trade. This ensures one bad trade won't wipe you out. Stop losses are your shield. Whether it's a physical stop order or a mental stop, know when to cut your losses. Hoping is not a strategy. Understand your Greeks. Delta tells you how much the option moves with the stock. Theta shows how time decay eats into your position. Vega measures how volatility changes impact your options. Know them, respect them, because in options, not knowing your risk is like flying blind in a storm. 2. Position sizing. Small steps first. You don't need to swing big to win. Start with 1 to 2 contracts. Learn how the option reacts to price, time, and volatility. Don't jump in with both feet. Avoid over-leveraging, especially with high-risk plays like naked options. Leverage can multiply gains, but it multiplies losses faster. Start small, learn the rhythm, then scale. 3. Education. Always be a student. Options reward the informed and punish the careless. Paper trade first. Platforms like Thinkorswim or Tastytrade let you practice real-time strategies without risking real money. Study volatility. Learn the difference between implied volatility, IV, and historical volatility. High IV equals expensive options. Low IV equals bargains. Don't overpay, especially before earnings or big events. The more you understand the why behind price movements, the better your trades will be. 4. Broker and tools. Your weapons matter. You're only as good as your platform. Choose brokers with low commissions and solid execution, like Interactive Brokers, Robinhood, or Schwab. Low fees matter, especially for small trades. Use tools like OptionStrat, Thinkorswim, or Tastyworks to visualize trades, break-even points, max loss, and profit potential. Don't guess, plan. A surgeon doesn't use a butter knife. Use the right tools for precision. 5. Timing. Know when not to trade. Not every moment is a good time to enter a trade. Avoid low liquidity periods like pre-market or lunch hours. Spreads widen and execution gets sloppy. Be cautious around earnings or major news, unless you're specifically playing a volatility strategy like a straddle or strangle. News can explode or destroy your setup. 6. Taxes. The silent killer. You made profits. Great, but Uncle Sam wants his cut. Most options profits are short-term capital gains, taxed at your ordinary income rate, unless you hold long-term leaps, which is rare. Understand wash sale rules. You might lose a deduction if you re-enter a similar position too quickly. Pro tip: talk to a tax advisor who understands trading. You worked hard for those gains. Don't lose them to paperwork mistakes. Options trading is a game of precision, patience, and preparation. It's not just about calling the right direction. It's about managing everything that happens in between. Protect your capital, educate yourself, use the best tools, and never stop learning. Because in the world of options, being smart isn't optional, it's essential. 1. Covered call, a simple strategy for steady income. Let's talk about one of the simplest and most popular strategies in options trading, the covered call. Imagine this. You already own 100 shares of a stock that you believe in. Maybe it's been steady, or maybe you're just holding it long term. But here's the thing. The stock's just sitting there, not doing much. What if you could squeeze a little extra income out of it while you wait? That's exactly what a covered call lets you do. Here's how it works. You take your 100 shares of a stock, let's say XYZ, and you sell a call option on it. When you sell that call, you're giving someone else the right, but not the obligation, to buy your shares at a set price, called the strike price, before the option expires. In return, you get paid a premium. That premium goes straight into your pocket, cash in hand, and you keep it no matter what happens next. Let's take an example. You own 100 shares of XYZ stock, currently trading at $50. You sell a call option with a strike price of $55 and collect a $2 premium per share. That's $200 in total income, just for agreeing to sell your shares at $55 if the stock gets there. Now, what happens next? Two scenarios. One, if XYZ stays below 55 by expiration, nothing happens. The option expires worthless. You keep your 100 shares and the $200 premium. That's pure income. Two, if XYZ rises above 55, let's say it jumps to $60, your shares get called away. You're obligated to sell them at $55. Now, yes, you miss out on any price above $55, but here's the thing. You still made $5 per share in stock gains plus the $2 premium. That's a solid $700 profit on a $5,000 investment. Sounds great, right? But let's be honest. There are pros and cons. The pros? It generates consistent income from the premiums, especially in sideways or slightly bullish markets. It offers a bit of downside protection. The premium you collect helps cushion small price drops. And most importantly, it's simple. It's perfect for beginners who already hold shares. But, and this is important, the cons? Your upside is capped. If the stock soars, you don't get the full ride. You'll have to sell at the strike price. You're still exposed to downside risk. If the stock crashes, the premium won't protect you from a major loss. And yes, it's capital intensive. You need to own 100 shares to do this, which can be expensive, especially with high-priced stocks. So, when should you use a covered call? Use it when you're neutral to slightly bullish. Maybe you don't expect your stock to skyrocket anytime soon, but you'd love to earn some passive income while you hold. And here are some smart tips. Pick stocks you believe in long-term, because you're going to hold them regardless. Sell out-of-the-money calls. Strike prices higher than the current stock price. That way, you get income without giving up too much upside. And avoid highly volatile stocks, because they can blow past your strike price or crash hard, neither of which is ideal. The covered call is like renting out your stock for extra income. You give up a little potential upside in exchange for steady cash flow.
Order filled.
For income-focused traders or anyone with long-term stock positions, it's a simple and powerful strategy. 2. Cash-secured put. Get paid to buy the stocks you love. Let's dive into another powerful option strategy, the cash-secured put. Now imagine this. There's a stock you really like. You've done your research and you believe in its long-term potential. But right now the price feels a bit too high. You'd love to own it, just not at today's price. So what do? With a cash-secured put, you can actually get paid while you wait for the stock to drop to your desired price. Here's how it works. You sell a put option on a stock, which means you're agreeing to buy 100 shares at a certain strike price if the stock drops below that level by expiration. But here's the best part. Just for agreeing to that possibility, you collect a premium up front. That's money in your pocket, even if the stock never drops. But why cash secured? Because you're setting aside enough cash to actually buy those 100 shares if needed. It's a responsible, lower-risk way to use options because you're only trading with money you actually have. Let's look at a simple example. XYZ stock is trading at $50. You sell a put with a $45 strike price and collect a $1.50 premium per share. That's $150 income right away. Two things can happen next. One, if XYZ stays above $45 by expiration, the put expires worthless. You don't have to buy the stock and you keep the full $150. No stock, no stress, just clean income. 2. If XYZ drops below $45, you're assigned the shares. That means you have to buy 100 shares at $45 each. But wait, you already collected $1.50 premium, so your real cost is $43.50 per share. That's a discount from the original market price, and you now own a stock you liked anyway, but at a better price. Sounds like a win-win? For the right trader, it definitely can be. Let's break down the advantages. You earn premium income up front, regardless of the outcome. You get a chance to buy a stock you already like at a lower effective price. And unlike a covered call, you don't need to own the stock beforehand, which makes it less capital intensive. But of course, no strategy is perfect. Here are the downsides you should watch for. If the stock plummets far below your strike price, you'll be forced to buy it, and that could mean losses. Your upside is limited. The most you can make is the premium, and your cash is tied up as collateral while the trade is open. You can't use it elsewhere. So when should you use a cash-secured put? It's ideal in bullish or neutral markets, especially when there's a stock you want to buy, but only at a lower price. It's like saying, I'm willing to buy this, but only if it gets cheaper, and I'd like to get paid while I wait. Here are some smart tips. Always sell puts on stocks you're happy to own for the long term. Use out-of-the-money, OTM strike prices to reduce the chance of assignment. Be cautious in high volatility markets. Sharp drops can lead to unexpected assignments at unattractive prices. Cash-secured put is like placing a buy limit order, but with a paycheck. You're saying, yes, I'll buy the stock, but only if it falls to my price. And in the meantime, you collect a premium for your patience. It's a strategy built on discipline, confidence, and smart risk management. And for traders who want to build positions the right way, it's a powerful tool. 3. Iron Condor, the smart way to profit when the market stays calm. Let's be honest, most traders love volatility, big moves, fast profits. But what if the market's just quiet, moving sideways? No big breakouts, no crashes, just range-bound action. Is there still a way to profit? Absolutely. And that's where the Iron Condor steps in, a powerful options strategy built for calm markets and steady minds. So, what is an Iron Condor? It's a combination of two spreads, a bull put spread and a bear call spread, stacked together in a way that creates a profit zone in the middle. You sell an out-of-the-money OTM put and an OTM call, and then you buy a further OTM put and call to cap your risk. This four-legged strategy forms a kind of wingspan on the options chart, and your goal is to have the stock price land gently between those wings. Let's make it simple with an example. Imagine XYZ is trading at $50. You think it'll stay somewhere between $45 and $55 for the next month. So you do this. Sell a $45 put for $1 premium. Sell a $55 call for $1 premium. Buy a $40 put for 30 cents. Buy a $60 call for 30 cents. Your total premium collected is $2. 60 cents was $1.40 per share, or $140 per contract. Now let's talk risk and reward. Max profit? That $140, and you get it if XYZ stays between $45 and $55 till expiration. Max loss? It's the distance between strikes, say $5 minus the premium received. So 500 to 140 equals $360 max loss. The big win here? You don't need to predict the direction of the stock, just the range. As long as XYZ stays between $45 and $55, you're golden. Why traders love Iron Condors? Defined risk and reward. You know exactly how much you can gain or lose before you even enter the trade. You profit from time decay. Every day the stock doesn't move too much, you get closer to your max profit. It works beautifully in low volatility environments, when markets are just drifting sideways. But hold up, this strategy isn't magic. It has its trade-offs. The cons? Your profits are limited. You only make what you collected in premiums. If the stock makes a big move in either direction, your losses can come fast. And it requires good timing and skill because you're managing two spreads at once. So how do you make it work? Here are some pro tips. Open the trade with 30 to 60 days until expiration. This gives time for theta decay to work in your favor. Choose wider strike ranges. Yes, you'll earn lower premiums, but your chance of success increases. And always be ready to monitor and adjust. If the stock starts creeping toward your break-even points, you may want to roll the position or close early to minimize losses. The Iron Condor is for traders who prefer calculated precision over high-speed thrills. It's a strategy that rewards patience, timing, and discipline. And when used correctly, it can quietly add consistent income to your trading portfolio, even when the market is just chilling. Think of it as a calm bird gliding across the sky, not chasing the storm, just floating between two ranges, collecting gains along the way. 4. Straddle and strangle. Bet on the move, not the direction. Sometimes the market gets quiet. Too quiet. You're staring at a stock, let's say XYZ, and you just know something big is about to happen. Earnings are coming up, a product announcement, an FDA decision, something that could make the stock move hard, but you're not sure which way. So what do you do when you don't want to pick a side? You just want to bet on the explosion. You reach for the straddle or the strangle. Let's start with the straddle, the more aggressive, premium-heavy strategy. You buy a call and a put at the same strike price, usually at the money ATM, and with the same expiration.
Order
It's a pure
filled.
volatility play. You're saying, I don't care if it goes up or down, just go somewhere. Here's a quick example. XYZ is trading at $50. You buy a $50 call for $3 and a $50 put for $3. Your total cost, $6 per share or $600 per contract. Now what happens? If XYZ jumps to $60, your call is now worth $10, while the put expires worthless. You make $1,000 minus the $600 you paid, a nice $400 profit. If XYZ crashes to $40, your put becomes worth $10, and the top call expires worthless. Same profit. But if XYZ doesn't move, say it stays between $44 and $56, you start losing money. Your break-even points are $56 on the upside and $44 on the downside. That's where the risk comes in. Time decay starts eating away at both options the moment you buy them. So if the move doesn't happen or doesn't happen fast enough, you lose. It's like holding a firecracker with a short fuse. The bang better come quickly. Now, if you want to reduce your cost a bit, you might choose the strangle. It's similar to the straddle, but here you buy a call and put at different strike prices, both out of the money, OTM. That makes it cheaper, but it also means the stock has to move more before you start seeing profits. Example, XYZ is at $50. You buy a $55 call for $1.50 and a $45 put for $1.50. Total cost, $3 or $300 per contract. Now you need XYZ to move beyond $58 or below $42 to make money, because that's where you recover your premium. So, which one should you use? Straddles are perfect when you're expecting a big move and you want the maximum potential, but they're more expensive. Strangles are more budget-friendly and they offer more room in the middle, but they need a bigger move to become profitable. Both strategies are ideal before major events like earnings announcements, merger talks, economic releases, or regulatory decisions. But timing matters. Pro tips: watch out for implied volatility spikes. Before big events, option prices can get inflated. This means you're paying more, and after the event, that volatility often collapses. Even if the stock moves, your options might lose value fast. Many traders actually close their positions before the event happens, locking in profits from rising option prices instead of risking a post-news crash. And always know your break-even points, because time decay doesn't wait for anyone. The straddle and strangle are tools for bold traders with sharp instincts. You're not playing sides, you're betting on chaos. You want fireworks. You want movement. And if you time it right, the payoff can be explosive. But remember, in this game, movement is money, and silence can be very expensive. 5. Protective put. Sleep peacefully, even when markets turn ugly. Imagine you've done your homework. You own 100 shares of a great company, let's call it XYZ, trading at $50. You're confident in the long-term story, but there's a nagging feeling. Maybe it's a looming Fed meeting, uncertain earnings, or just the market acting weird lately. You don't want to sell your shares, but you do want protection, just in case the market throws a tantrum. That's exactly where the protective put shines. So what is it? A protective put is like buying insurance for your stock. You already own the shares, and then you buy a put option, which gives you the right to sell those shares at a set price. If the stock falls, your put kicks in and limits your losses. Let's walk through a real-world example. You own 100 shares of XYZ at $50. To protect your position, you buy a $45 put option for $2 per share, or $200 total. Now let's say the market turns and XYZ tumbles to $40. Without the put, your loss would be $1,000. Ouch. But with the put in place, you have the right to sell at $45, which means the put is worth $5 or $500. It doesn't erase the loss completely, but it cushions the blow, and that's the whole point. On the flip side, what if XYZ goes up to $60? Your put expires worthless. Sure, you lose the $200 premium, but your stock has gained $1,000. You're still smiling. That $200 is simply the price of peace of mind.
Order
Why traders
filled.
love the protective put? It limits your downside. Your worst case scenario is defined. But it doesn't cap your upside. You keep all the gains if the stock soars. It's perfect for uncertain environments, when you're bullish but also cautious. It's like wearing a helmet. You hope you don't fall, but if you do, you're protected. But like all safety nets, it comes at a cost. The drawbacks? The put premium eats into your profits. If the stock doesn't fall, that money's gone. Time decay. The put loses value every day if the stock stays steady or climbs. And if you're protecting a high volatility stock, the insurance gets expensive fast. So, how do you use it wisely? Here are some pro tips. Buy longer dated puts if you want sustained protection. They cost more upfront, but don't decay as quickly. Use at-the-money ATM or slightly out-of-the-money OTM puts. They're a good balance between protection and cost. And if your stock keeps rising, consider rolling the put, selling the old one and buying a new one further out to keep your shield in place. The protective put is for the smart, disciplined trader who understands that risk is always around the corner. You believe in your stock, but you're not naive. You're prepared. Because in this market, confidence is great. But confidence with protection? That's real power. Trade boldly, hedge wisely, and sleep well at night. Key considerations for choosing an option strategy. Trade smart, trade right. Let's be honest. When it comes to options trading, the possibilities are endless. Covered calls, straddles, iron condors. It's easy to get overwhelmed. But here's the truth. Not every strategy is meant for everyone. The real power lies in choosing the right tool for the right moment, based on your goals, your outlook, and your comfort with risk. So let's break it down, step by step, so you can match the right strategy to your unique situation. 1. Market outlook. What do you think the market will do? This is your starting point. Ask yourself, are you bullish, bearish, neutral, or expecting a storm of volatility? Bullish? You believe prices will rise. Go with covered calls, cash-secured puts, or protective puts. These let you profit from gains and provide some downside cushion. Bearish? Expecting prices to fall? Think long puts or bear call spreads. These give you a chance to profit when stocks tumble. Neutral. You see the stock going sideways. Time to consider iron condors or short straddles, only if you're advanced. These strategies thrive when prices stay range-bound. Expecting big moves, but don't know which way. That's where straddles and strangles come in. Perfect for pre-earnings, big news, or anything volatile. 2. Risk tolerance. How much can you afford to lose? Emotionally and financially. Options can be risky, but not all strategies are created equal. Low risk? You want safety first. Stick with covered calls and cash-secured puts. They're defined risk, income-generating plays. Moderate risk. You're okay with some complexity. Go for iron condors or spreads. Controlled loss and gain, but needs a bit more
Order
know-how.
filled.
High risk? You're aggressive and maybe experienced. Straddles, strangles, and naked options fall here. These can offer big rewards, but the downside can be brutal. If you're not ready, don't play with fire. 3. Capital. What's your budget? Some trades need deep pockets. Others, not so much. High capital requirements. Covered calls and protective puts need you to own 100 shares, which can get pricey. lower capital alternatives. Try cash-secured puts, credit spreads, straddles, or strangles. You can control risk and position size more easily. Remember, options give you leverage, but that doesn't mean you ignore risk. Start small. Scale wisely. 4. Experience level. Be honest with yourself. Beginner friendly. If you're new to options, start simple. Covered calls and cash-secured puts are straightforward, income-based, and help you learn the ropes. Intermediate level. Once you understand options behavior, try iron condors and protective puts. These require planning and a better grasp of Greeks like delta and theta. Advanced traders only. Straddles, strangles, and complex spreads are powerful, but tricky. You need to understand implied volatility, time decay, and be ready to adjust fast. 5. Time commitment. How hands-on do you want to be? Your schedule matters. Some trades need babysitting. Others let you set it and forget it. Passive strategies. Covered calls and cash-secured puts often don't need much attention. Set them up, check in now and then, and collect the premium. Active strategies. Iron condors, straddles, and high volatility plays. These need active monitoring, potential adjustments, and quick decision-making, especially as expiration nears. There's no one-size-fits-all in options trading. It's like choosing a tool from a toolbox. You pick based on the job at hand. Ask yourself, what's the stock likely to do? How much risk can I take? How much time can I commit? What's my experience level? And how much capital am I working with? Answer those honestly, and you'll never pick the wrong strategy. Because in options, the secret isn't in trading more, it's in trading smarter. I hope you found these strategies and insights useful for improving your trading skills. Remember, success in options trading is all about managing your risk, knowing when to enter, and using the right tools. Keep practicing, stay disciplined, and you'll get there. If you enjoyed the video, make sure to like, share it with your fellow traders, and subscribe to the channel so you never miss out on more actionable tips and strategies. Thanks for watching, and I'll see you in the next one.
Shady deals, hidden conflicts, and prop firm chaos going on surrounding Project X, Michael Patak's SRO idea, Blue Sky having some troubles, and then Top One sneaky little rule change over the weekend are rocking the prop firm world right now. You're going to want to stick around because all of these things could affect your trading and you're going to want to know how. Let's get into it. Welcome to the Wild West right now of prop firm trading. Today we're diving deep into some stuff that's shaking up the entire prop firm world. Project X isn't being talked about thoroughly here, but they have some conflict of interest where they could be sharing trader data with firms in between each firm. Michael Patak's pushing for the SRO, but SROs require transparency. We're not seeing this transparency happening over here on Project X, while people are asking flat out, do you own Project X or any part of it? And then we also have Blue Sky dramas going on with them actually responding to trader critiques. Top One sudden rule change over the weekend that has a thunderstorm of stuff going on. People aren't happy at all about that. And a lot of people are saying, I told you so. So buckle up because the news is nonstop this week and you're going to have decisions to make here moving forward that are going to impact your trading directly. Let's jump into this. All right, guys, as we get this thing kickstarted, the best way to kickstart anything is with a giveaway. We're going to be giving away a Take Profit Trader evaluation account, and all you have to do to participate is like the video, comment in the comment section, share the video, and smash that like button. Did I already say smash the like button? Anyways, do those, and you're automatically entered. I will announce the winner in the community section of this channel, and what you want to do is hit the notification bell so that when I post the comment or post in the community section, it'll let you know, and you'll see if you won or not. I'll also obviously tag you, and as long as you did all those things, you'll be able to claim your prize. Another thing you can claim is with coupon code all caps JESSEW is massive discounts going on right now. Check out the links in the description and comment section of this video to Take Profit Trader, My Funded Futures, Tradeify, Trade Day, and much more like Earn to Trade and APAC. Now let's go ahead and get into it. So let's jump into it right here on X. Storyteller Myth has something to say about Project X and TopStep and their possible link. Project X and TopStep are definitely tied at the hip. Former COO of TopStep, went to head up Project X. 3 members on LinkedIn, Casey, and 2 programmers, meaning almost certainly incubated in-house and then spun out. Such an arrangement usually means TopStep owns a percentage of S2F. And if you come on over here and you click, you're going to see KCM, right? After an incredible 2-year run at TopStep, I'm excited to announce I have accepted the position of president at Project X Trading LLC. I look forward to the challenge of directing a small and nimble, globally diverse group of software engineers, project managers, and support personnel as we look to offer futures trading technology with innovative and cutting-edge solutions. Oh, and we're #hiring. This was a year ago. And we click out here, go over to this, and it's a post where you can see clearly here, Project X Trading LLC, the 3 people, right, that he's alluding to over there, which is KCM, obviously we know, and then the 2 software people, okay? And when we click out of that, we can come on over here and we see that Casey was obviously TopStep Chief Operation Officer from July 23rd to March 2024. So full-time 1 year and 11 months. And then, you know, bam, March 2024. Becomes president of Project Trading LLC, and he's been there for 1 year and 2 months. When we click over here, we can see KCM announcing the TopStepX platform, building a trading platform from scratch. Some might call it crazy, actually some did, but teaming up with a group of world-class software engineers who were just as eager to build as we were, allowed TopStep to turn the idea into an awesome reality. I'm proud to be a part of the effort and work with an amazing group. Today, I'm excited to introduce everyone to TopStepX, our latest leap in futures trading platforms. It's different, it's innovative. I feel like we're using innovative way too much, and we can't wait for our traders to try it out. And this leads me to what I have actually mentioned about 3 weeks ago. I posted on X and I asked, because I thought always Project X was owned by TopStep. So I asked Michael Patak and Dakota, some questions about Project X and the way they run things and the way they onboard new prop firms and what type of requirements new prop firms must have and kind of check off before Project X would actually take them on as a client and provide them the software, the data, etc. And that went unreplied. They never replied to that. Nobody ever did. And that got me thinking, and I guess other people started seeing certain things and asking difficult, even bigger questions than the one I had asked. They started asking, hey, TopStep, do you guys own Project X or run it, or what's going on there? And to me, I always thought they owned it, because when TopStepX launched, they made it seem, and they worded it on social media, and I'm not the only one who saw this, as if they owned it, as if they developed it. And this again is one of those types of X posts or tweets or whatever there was back then, where it seems like they owned it, like they developed it. And I mean, that's how it reads to me. And why is that a problem? Well, it's a problem only for one simple reason, because if it was just a software platform, fine, right? If it was a software platform that ran itself how it should run itself, no problem. But there is a small yet big hiccup. And here it is, posted by Web. This is something that I had seen on social media, and it seems like it's been removed from the Project X website. I can't find it on there anyways, and I've seen a few people on X talk about how Project X has actually removed that from their website. And what was it? Well, it was kind of like in their FAQ section. What about your back office tools? We have a very robust admin interface that allows you to monitor traders, positions, and orders, create, close, modify accounts, execute, pull, and flatten positions and orders, and more. All fine and dandy, right? Because it's part of running the show, let's say. So there's not a problem there. At least not for me personally. I don't see any problem in most of what it can be done there. That they can
order filled
positions. I mean, I guess that should be, because if like a panic button, if there's an issue going on and you can't close it, you got to call them or communicate with them to close your position. They have to be able to do that.
Order filled.
So I don't see a problem there. But here is where the problem starts. Our platform also has cross-firm risk monitoring, meaning if a trader is trading at a firm A and firm B and the same exact time, we will alert both firms of potential fraudulent behavior, hedging, grid trading, team trading. So if you're trading at firm A and you're trading at firm B, and firm A sees that, hey, this trader is trading at this firm B over there. I wonder how they're trading over there, because maybe they can't see that. I don't see how they can't see it anymore, but maybe they cannot see that, right? So they're over here, you're at firm A, you're long, and you so happen to be long at firm B. I've done that. I've been both-sided trade on two different firms because I'm trading multiple firms, and this firm A calls firm B. Hey, is so-and-so, I see that he's over there a trader with you and he's in a position right now. Is it long or short? And then that firm says, oh yeah, he's one of our traders. He's long right now, or he's short right now, whatever it is. He might be short MQ, long MQ over here, short gold over there, and they communicating, they share that. Should that be something that should be done? No, absolutely not. Why? Because these firms are the custodians of your information and my information, meaning name, addresses, social security numbers, EIN, all of that stuff is there because we're contractors, meaning they have to give us tax papers at the end of the year, at the beginning of the following for the previous year so that we can file our taxes, often being 1099s for an individual against your social security number, or 1099s to a corporation using your EIN number, meaning this is private information, right? They're custodians of our information. They need to safeguard that information so that nobody can get it, and they can't share that information with other people, right? It's just that simple. Now, what I don't want to see is in the future here, contracts begin to change and then making us sign away our rights to protecting that information exclusively by them and not being able to share it, where they can put in the contract possibly saying, hey, you're okay that if we share your information with firm B, C, D, and so on and so forth. That could be the case where they do that if they're a Project X user. And we're seeing a lot of firms that I like thoroughly, start to utilize Project X. That's dangerous. If this is something that is happening, I don't like that. You shouldn't like it either. So then if we're going to be starting SROs, right, is it the same people that are starting SROs, the same people who own, partake, or coded this type of technology? And what's the point of the SRO? Because the SRO is supposed to be to hold firms accountable, to make sure they are above reproach. The people who are doing the SRO need to be above reproach. They can't be involved in shady stuff like this, at least in my opinion. And if the SRO is for the benefit of the traders and the safeguarding of firms, then this right here doesn't seem like it's for the benefit of the traders at all. Not to me anyways, because it doesn't seem to me that my information is being safeguarded. I don't like that very much. I like my information to be safeguarded by the custodians that are supposed to be guarding that information. So we're not seeing a lot of transparency here. These questions have been asked on Twitter, on X, and they have not been replied to. They've been completely ignored for the most part. And I've not been the only one asking questions. And that's what we're doing. We're asking questions because we're seeing things online and we're like, this doesn't make sense. I don't like that. Who's in charge of this? Who's in charge of that? If everything's supposed to be about transparency and these bigger firms are supposed to be transparent, we're not seeing it right now. And they better get transparent quick and in a hurry before people start to vote with their pocketbooks on what firms they think are transparent and which firms they think are not being transparent at all. And speaking of transparency, check this out. Top One just came out very recently. What was it? About 3 weeks ago. And they're already changing rules big time. Let's see what the CEO has to say.
Hey traders, Matt Morris here with some important updates and some rule modifications for new accounts starting this Sunday, April 27th at 5 p.m. Eastern. Now, you're going to have to bear with me. I've lost my voice a little bit here, but I want to start with some big news. In our first month in business, in less than 30 days, nearly 10,000 traders have joined Top One Futures. What we know is one of the largest launches of any prop firm in history. In fact, in pretty much any industry, to generate 10,000 customers or close to that is unheard of in this time frame. Now, we've already paid out well over $700,000 to our traders with an average payout speed of less than 4 hours. And our 24/7 customer support team is responding in under 60 seconds on average. We know that to be a level of execution that few firms in this space can match. We've also had over 300 5-star reviews on Trustpilot. So I want to first off say thank you for your incredible trust and support in building this community with us. Now, that is not to say that we have been perfect. We've definitely had a few technical challenges, some website glitches that our team has worked through, and those things come with this kind of rapid growth. And as more evidence of us not being perfect, and in the spirit of just total transparency, I want to talk about 2 important rule changes that we're implementing, again, only for new accounts purchased after 5 p.m. this Sunday. And before I even talk about this, No matter what anyone might say, there is not one long-standing prop firm in our industry that hasn't had to modify their rules. Name the biggest, most respected prop firms out there, and every single one of them, without exception, has tweaked their rules over time. So why are we making the change? Well, based on our current rule set and our payout ratio, even only being in business less than 30 days, on a weekly basis, our payout ratio is about 50% of revenue and climbing. And while this could be sustainable in the short term, the trend is increasing day over day at a level that we don't feel is sustainable long term. And as I mentioned in my very first video on our launch, two of the top core values that we've built this company on are trust and sustainability. And without sustainability, there is no trust. And so there are two rule changes that we're making. And again, only to new accounts purchased after Sunday. Whatever account you're trading on right now, you can continue trading on it. So first off, profit targets. Currently, to achieve a payout, you need to achieve a 2% profit on your starting balance from payout to payout. Now, the new rule is that on your first payout, you'll need to achieve a 5% profit target of your starting balance, then 4% of your starting balance on your second payout, and then 3% profit on each additional payout. Next, we are slightly lowering the max payout caps on some funded accounts. So $3,500 max payout on $150K. Now, if you have 3 accounts, obviously you can pull out 3 times that, or $10,500. $3,000 max payout on a $100K account, $2,500 on a $50K account, and then $1,500 on a $25K account, which is the same as it was before. Now, our live plan has no changes. So after your third payout, you'll be eligible to be moved to live, where there are no payout caps, and the focus becomes scaling your live capital with no consistency, no payout caps, allowing you to literally earn an unlimited income.
So there you have it. They have not even been opened an entire month and are already changing rules. And why is this a problem? Well, then it's a poorly launched thing, because what you're saying to me, right, is that the rules there's 2 things here. There's only, in my opinion, 2 things here. It means, number 1, we poorly planned this and we launched, and our payout ratio is not sustainable, and we're going to be insolvent in a couple of months if we continue down this path, because we didn't do a good job when we launched. And now we have to rectify it on the fly and quickly, because he mentioned, oh, every firm has changed rules. Yeah, but every firm hasn't changed rules less than a month after launch. That's crazy. So number 1 is that we don't know what we're doing and we screwed up, and now we got to change rules. Or number 2 is we knew exactly what we were doing and we were going to bait and switch your ass after 3 weeks running the show. And that's it. It's one or the other. I mean, if you can think of a third option, I am more than open to hearing what it is, reading it in the comments section. But from my standpoint, I only see 2 options. Either we don't know what we're doing and we launched poorly, or we knew exactly what we were doing and we knew we were going to get our name out there, and you know, it was going to be costly marketing, because if traders start to get payouts, we were going to pay a lot of money out there, and between staff and overhead, we were just, you know, there was just not enough money to make this worthwhile at the end. So we're going to do it a short period of time, get our name out there. It's expensive marketing. It's one or the other, for me anyways. If you have another opinion, drop it in the comment section and let me know. Hopefully this change is, you know, it's good and it keeps the firm alive for a long time and traders paid. But right now, I didn't have much faith in them to start because of their MLM type of feel for the affiliates. And this guy coming from an MLM background, I just didn't like any of that. So I stayed away from this firm. And now after this, more flags are popping up, more red flags are popping up for me, and I'm staying further away from them because of these things. And I know some people are going to trade with them. Some of you watching this probably already do. I hope you get your payouts, and I hope everything works out well for you in the long run with them. I really do, because the industry doesn't need any more black eyes. And speaking of black eyes, the other day, somebody asked me, hey, Jesse, why don't you do a segment on Blue Sky? And honestly, my man, I'm sorry. I completely forgot about that. And Blue Sky is not something that's ever been on my radar. I've seen it mentioned here and there. I don't even know that I've ever been to their website, but this popped up in Twitter on the 25th of April from somebody named Tom, and he has going to do a review of Blue Sky and why I think they need to be clearer.
Order filled.
$3,000 moved to brokerage, took a $600 payout, and was left with a $1,400 MML, maximum loss limit. Where'd the other 1,000 go? Good question. And you can see it all right in here. And then if you scroll on down, you see Uncle Bugatti. Wait, so they're stealing from traders on the live account? And here is where the kicker is. It's not even a live account. They call it brokerage and it's supposed to be live. But too many people were blowing up, so you start in sim brokerage. So are you telling me that I go from an eval to a sim brokerage? What? What nonsense is that? If you don't think that the person is ready to go to live because you're afraid that they're going to blow up, you look at their analytics and it shows the very likelihood that they're going to blow up their live funded account, then just keep them in sim funded longer. What are you talking about live? Why would you move them to live brokerage? Not only that, they charge $140 CME fees in sim brokerage, claiming Project X passes on those costs. I call BS. We'll find out. Oh my God. So in the brokerage, in the sim brokerage, right, which is like supposed to be live but it's not live, they're charging you $140 for CME fees. Why? There's no difference in sim brokerage to sim funded. It's the same damn thing. What's happening here? Apparently Michael Patak says he's curious about that too on the Project X side of things. So let's scroll down. I had a horrible experience with Blue Sky. I was going to do a review on them and forgot as I was too busy with other prop firms. Took 3 accounts to live and they kept my 3K hostage out of 9K that was transferred to live. So then we scroll on down here and we see Tom again, Project X Trading. Can you please confirm you charge CME fees for sim trading? And you see a chat here. I don't know why blur this out. As you are clearly entitled to your opinion, those are the rules. As I have said in Discord, they are part of the agreement with Tradeovate and Project X with the sim funded program they provide us. If you don't want the fees, as you would have to pay in brokerage anyways, then you have the option of a Rhythmic account. And then live accounts are capped at 3K. These are sim funded. Then you move to live brokerage, which is still sim. What the fuck is going on here? Can we get clear rules? Guys, we are now 2 months into sim funding and finding people who aren't following the rules. Funded accounts will be evaluated at 10K in profit for a potential move to brokerage. You must open a ticket. Failure to do so may result in denied payouts above 10K in your funded account. I don't want to make an example out of anyone as you work hard to make the money, but it seems it's too hard to follow and we will continue to enforce. Well, imagine in what world does the trader who's trading have to be like, oh, I reached $10,000. I got to stop trading. Let me email them and let them know that I reached $10,000 and that now I need to be moved to brokerage account. Why should that be on the trader? That should be exclusively on the firm. The firm has all this fancy software. At the end of the day, when the trader's accounts are closed and the data is updated, if they have $10,000 in profit in the account, the system should automatically put a check mark on that thing, contact the trader, send a POA agreement, and get the ball rolling to move them to brokerage. What are we doing here? And fast forward, and it seems like Blue Sky has actually made a quick little change, and it was something that should have just never happened, but well, at least they are fixing it. Props to them, pun intended, for removing data fees in sim brokerage. Yes, it was Blue Sky. I give them credit for listening to feedback and making adjustments. To be clear, my experience so far has been positive. I still don't like the 1K MLL, but I can always trade elsewhere. So important updates regarding live sim funded and brokerage accounts. We would like to clarify some recent misconceptions regarding our live sim funded accounts and brokerage accounts. Blue Sky has introduced a live sim funded account following successful completion of Blue Live. God, that just sounds so complicated. Please note that a live sim funded account is not the same as a brokerage account trading on a live market. While some companies may refer to their brokerage process as live, at Blue Sky we have always maintained a clear distinction by referring to them specifically as brokerage account. Once a trader reaches 10,000 profit target in a live sim funded account, they must open a support ticket to request a review for possible transition to a brokerage account. See, that's a problem. That's poor management of your customer. That should not be on the trader. It shouldn't be. That should be on the firm, because what happens there is that you take your payouts and you keep trading and take payouts, and then you reach 10,000 bucks and you don't even freaking notice it. You might not notice it. And then all of a sudden, you keep trading and you got like $5,000 more that you've made. Obviously your balance isn't at 15,000. It might be at 8,000, right? Because you've taken payouts along the way. And then all of a sudden you go put in a payout and boop, you don't get the payout, or worse yet, your account gets breached because you violated the rule of, trading into that. Now, I don't know if they will breach your account for that, but we did read earlier that they will not pay you for that, right? So you need to be on top of this. This is why I always say you need to be on top of the rules for the firms you trade for. A few additional points to note: live sim funded accounts no longer require data fees. There you go. Congratulations. You should have been done that from the beginning. That shouldn't have been a thing. If your account is transitioned to a brokerage account, you will be responsible for paying the professional data fees. We all know that. That's across the board with basically every firm. Additionally, level 2 data will soon incur a fee across all account types. Further details regarding that change will be announced shortly. But that's it right there, right? Two things. This should have never happened. This data fee thing for $140 should have never happened. And this right here, your software should be keeping track of your traders' progress. And when they hit $10,000 in profit, it should do like a little check mark. Let the trader know on their dashboard, you've reached this milestone. We are reviewing your account for brokerage accounts, transitioning, and then stop trading. Do not trade this account any further because you will not be paid out of any profits you make on here. So please hold tight, and then you got to do that in a timely manner. It can't take a month for you to tell that trader, oh, we're going to do a brokerage account for you. Oh, we're not. That's got to be done in like 24 hours. Well, 1 to 2 business days. All right, because if it's Friday, I get it. 1 to 2 business days, that trader should receive an answer. Hey, guess what? Congratulations. We're going to start your brokerage account now. Here is the POA. Go ahead, sign it, send it back to me. And we're going to be, you're going to be trading live in 3 days, for example. Or an email saying, hey, we don't think you're ready for brokerage. Keep trading. We'll reevaluate in a month, and then have a reevaluation every single month, right? That trader might have to get paid a little bit more, or they might blow up the account. You just never know what's going to happen. But that's the whole point of reviewing their analytics, their data, and then making the determination whether or not they move on to brokerage or whether they stay in the live sim funded. And that way, the trader isn't disappointed. So let's move on. And disappointing experience with Alpha Futures. I scale in and out with micros, and one single day I had my trade count more than 100. Alpha not only denied my payout, but breached my account as well. Ouch. Uncle Bugatti, what do you mean by more than 100? What rules did they say you break? And then Ben Chaff, I don't know. He's the COO over at Alpha Futures, put a screenshot here. Trading HFT, high frequency trading, particularly those resulting in over 100 trades per day, and Alpha Prime team is not interested in working with strategies taking 100 plus trades per day, automated or not. That's one of those things where it's very, very much black and white. I can see where somebody can end up with like over 100 trades trading micros. Because it's both ways. And if you're scaling in and out and your trades are lasting an hour, 2 hours, 3 hours, 4 hours in a day, I could see where that can happen. It could happen. And it's not high frequency trading, so that's horrible wording by Ben. And it's not necessarily automated either. You're sitting there, right? You have your level set up. You have something that'll alert you. You come back to your desk, click, click, click. But I mean, if it's the rule, it's there. One should know. And this is why it's very important, and why I always tell you guys, pay attention to the rules at the firm you're trading for. I always say, don't fanboy over any single firm. But if you're trading at a firm, you need to inform yourself thoroughly of their rules so that you're not caught in a situation where you violate a rule and you didn't know you violated it, right? Like this one is something that somebody that trades a lot of micros could violate rather easily because of this trade count. Trader Gary says, taking over 100 trades per day, in quotations, I use micros to scale in and out. On a one specific day, I had 200 trades. All of the days I have less than 100, and the majority of those days less than 60. So you could double the limit and expect no consequence. One time, 101, we've turned the cheek several times for people, completely ignoring the rule there's no tolerance for. I get both sides of this issue. And this is again why I say, in order to avoid disappointments, you have to be in tune with the firm you're trading for and what are their rules. And then if you violate a rule that you didn't even know existed and you realize it's your fault because you didn't read, you didn't look, you didn't dive into it, then don't, you can't get mad, man. You just can't. And I'm not talking about, what's this guy's name? I'm not talking about Trader Gary. I don't know how readily available this firm's rules are. And that leads me to another thing. Whether it's Alpha Futures or any other firm, the rules should be extremely transparent and easy to get to. For the most part, I shouldn't need to make a 25, 30-minute video so that people are informed of the rules thoroughly. Don't mind, I enjoy making the videos, but you need to dive in. You need to look at what the rules are so that these things don't happen to you. so that the only thing that happens to you is actually being able to take advantage of good discounts on firms and getting payouts out of these firms. Guys, thank you very much for watching. Remember to smash that like button for me, subscribe to the channel. If you haven't, hit the notification bell so you're alerted when I go live or upload another video, and I'll catch you on another one. Peace.
There's been a lot of media hysteria, some ambiguous and some negative polls, but here's the main course of action that we're all looking at. It's 100 days, and we're right in the middle of everything, and yet people are already talking about Donald Trump as if he's failed or there's an obituary. Nothing could be further from the truth. Everything is in play, and we